Welcome back to the channel, everyone. We're here with Dividend Stockpile, where we talk about dividends, dividend growth, options, and anything income related. Today, I'm super excited to have Russ here with us from the Dapper Dividends YouTube channel, podcast, newsletter. What else you got there, Russ? So welcome.
It's a universe. It's this strange universe I've created with my particular brand of investing. I don't talk humor, whatever the heck you want to call it. But yeah, everybody, most of you know who I am. I'm Russ. I'm your favorite welder that's passionate about passive income, and I've been investing since I don't know. Well, I've been investing since 2003. But I know we've talked about this, but actually making moves that you are being intentional about really started in 2018. And I took the path of most people, starting with penny stocks, because why am I going to buy a share of Johnson and Johnson for $125 when I can buy 5,000 shares of something that's trading at a quarter of a penny or something? And yeah, anyway, I learned quickly that penny stocks are a great way to lose money. Got into swing trading, and then it was while I was swing trading that I stumbled across dividend payments, and kind of went down a rabbit hole that I haven't come back up from yet. And I'm pretty happy down there here with you.
Yeah, awesome. Thanks so much for that. Yeah, I think a lot of people are in the exact same situation. They start off a path going one way, and then they realize that it's not a sustainable path, and then they find what does work for them. And so, to your point, for us, it's dividend investing, income investing. So that's awesome. All right, so for everyone else, a few weeks ago, we got together on your channel. We talked about some of the best stocks for beginner dividend investors. So we ran out of time, and of course we could have talked for hours, I think. So we came up with the idea to have you on my channel this time. So we're going to continue that conversation, add a little bit more of the in-depth processes that we go through. Some of the things we want to talk about today is our preferred valuation methods of what kind of valuation methods we look at when we're looking at a stock. We're going to talk about some dividends that we would recommend for people who are a little bit older, maybe in retirement or very near retirement. And we're also going to talk about some of the stocks on our watch list right now, or stocks that we're buying. In addition, we're going to chat about some news that's been coming up over the last couple of weeks. So with that, let's get started. So let's start off with some of the news. So I know there's a lot going on right now. One of the big things that everyone's probably heard about is the Federal Reserve lowered interest rates. So that's a huge change. Over the last year and a half, we've been having rising interest rates, and now we have a decrease. So Russ, what's your initial thoughts on the decision yesterday, the market's response? How are you feeling about it all?
Well, over the long run, the market's just going to go up and to the right as the whole. I mean, individual companies obviously can come and go by the wayside, but I think the biggest news, I just realized I forgot my little lantern here to turn that on. So there we go. Now I'm ready. I was feeling out of sorts, but honestly, I guess the market, as we were talking before, it'll never go down again. The laws of the economic laws have just been repealed. They don't apply anymore. There's no more corrections, crashes, bear markets, any of that. But I mean, they're cutting rates when it looks like, we could have some weakness in the economy. And I don't know, will we hit a recession? Maybe, but the market loves it. They love everything, right? I guess we're back to bad news is good news is good, no news is good. Just the market's going to go up, and keep buying, man. I've been stockpiling a little bit of cash, too much, and now I'm starting to feel that maybe I was timing the market. I don't know if you ever experienced that. You like sitting on cash, but now the market just keeps going up and up and up, and there you are sitting on too much cash. So, but overall, just to give that thought, in the long run, I don't really pay too much attention to what the Fed is doing with the interest rates. And I mean, years ago, nobody knew it like we did. I mean, it's almost like a Super Bowl watch party now when it's Fed decision day. Crazy. People would read about it days later in the newspaper,
Yeah, exactly. It's totally different with the 24-hour news cycle and all the financial talking heads on all the different social medias as well as traditional media. You can't get away from it now. So to your point, it is this big deal where a few years ago, even with Greenspan or forget his name, but the Fed chair during the Great Recession, you never heard like as big of a to do as it is now. So it's definitely a different environment now. Well, I mean, after today's stock market, definitely feels like it's was a positive thing for the overall market. I mean, especially your higher risk companies like your tech companies, they what 2-3% today. So it was quite the boom, if you will. So we'll see how it all ends up. To your point, the economy's good, but it's not great. So it'll be interesting to see where it all goes going forward. Another interesting bit of news today is about Nike. So it's one of your stocks that you're a fan of. I personally don't own it, but let everyone know what happened today, I guess.
Yeah, these sons of guns, man. I tell you, first, I was starting to build a really nice position with Starbucks. I think I'm at 78 shares, maybe 77, something like that. Headed toward 100. Thought we were good. I thought I had a lot of time. And then all of a sudden, they bring in a new CEO and the stock just jumped. That one, though, is a little bit different because Brian Nickel was the CEO at Chipotle. And he is just like a rock star of CEOs. So that's a little bit different, but yeah, Nike brought somebody out of retirement. Elliot Hill is his name, and he was the president of consumer and marketplace. And the dude had been with the company since 1988 as he started as an intern. He retired in 2020. So I tweeted out the thing of the kid. Is that little rascals or something throwing money out the window? That's just throw money at the guy, bring him out of retirement, make him an offer he can't refuse. But the stock market liked it. It was trading around $82 today, and then after market, when the announcement was made, it was up around 88. So it got a little bit of a boost. We'll see if it lasts, but that's good, man. It's we always say these businesses are living, breathing entities, and their first order of business is survival. So when you get somebody like a Laxman Narasimhan and Starbucks not doing a good job, the company is floundering. They're going to take steps. Kind of the same thing. John Donahoe is the CEO, or he is the CEO until October 13th, but October 14th, Elliot Hill takes the reins. And yeah, John Donahoe is kind of like a CEO for hire guy. He was at eBay, he was at ServiceNow, ticker NOW, and then now he was at Nike. So he just kind of bounces around. But I love seeing that where somebody like Elliot Hill, as I was reading about him, just has Nike in his blood, understands the business. People around the company speak very highly of him, and John Donahoe is like, not so much. And uh, do you ever get that feeling when you could just kind of tell when somebody's come up through the company? And hear me, I'm Brian Nickel with Starbucks, right? They just bring him in, but hey, maybe he's a magic man. John Donahoe certainly wasn't. So I don't know. We'll see if they can turn these companies around, right?
Yeah, what's the Warren Buffett quote? Invest in companies because they can run themselves because one day like an idiot will run them. That's what it reminds me of this Donahue guy. Didn't he like shut down all the partnerships he had with all the different retailers and try to do an online or like direct to consumer push, and that totally blew up after COVID was over or something like that?
Yeah, he had the brilliant idea. Well, of course, during COVID, when all the stores were shut down and Nike started seeing the DTC, the direct to consumer, hey, they're cutting out the middleman, so they're making more money, right? And it was good until people started going back into the malls and trying on shoes. They wanted to touch them, feel them, walk around the store on them, in them. But yeah, and then all of a sudden it started tapering off, and people kind of revolted or rebelled. They just didn't. They weren't using the digital as much, and it went down. Dude, he's getting sued over it. Him and the CFO Matthew Friend were. I guess people said they misled investors, but you know that's what he did. They made a bet on going DTC, cutting out Foot Locker and Journeys and a lot of these other brick and mortar retailers to try and make more money, and it ended up backfiring big time on them. So that was probably his major undoing. That was a big misstep, but that's they try something, it doesn't work, you lose your job. I guess it's
Exactly.
things move quick.
The buck stops with the CEO a lot of the time, so it is what it is. And I've heard that all the retailers that couldn't get Nike products moved on to some of the other brands, and so those brands are actually picking up market share where Nike was losing it. So hopefully, this new CEO can turn it around and get those relationships back. I mean, shoes are one of those things where I personally would want to go in the store and try them on, feel them out before I get them shipped to me. That's kind of weird. So it was a weird concept, and I mean, maybe right in the depths of COVID, it made sense, but long term, you had to expect people to want to come back to the store.
Yeah, I mean, again, Elliot Hill, he was I think it was a very strategic move because he was, when he retired, the president of marketplace and consumer. So, like,
Yeah,
I think he's going to repair a lot of these relations. They could just blame everything on the CEO that's leaving, and hey, hopefully he gets back in and can. I think it'll be good. And again, this is why I always say, watch the businesses, man, because they're living, breathing entities, and if they're struggling, they're going to do something to shake things up. You would hope so. The board, at least, right? That's the board's job, is to fire the CEO. Like, they're supposed to keep tabs on the CEO and replace him if necessary.
makes you wonder if they're behind the ball when it comes to this guy. They should have maybe done it a while back, and the returns of Nike might have been better over the last year or so. But at least they're making a decision. They're moving on. So we'll see how it ends up going.
Heck
Uh,
yeah.
some other news that was really big last couple of days is Microsoft. They raised their dividend again around 10%, which is right along their average for the last 5 years. They also announced a $50 billion buyback. So, sorry, $60 billion buyback. So that was quite big. Are you invested in Microsoft at all?
Not outright. I had started a position. This is how brilliant I am. I started a position coming right out of COVID. It was the fall or winter of 2020, and maybe a little bit later, but it was right. They were right around 200, and I thought I'm going to go heavy under 200, and I had two shares at maybe like $210. And I waited and it went up. I'm like, "Oh, I'm gonna wait." And I waited and waited. It just kept going up and up. I think I sold those when it was at like 330 or something. And here's me. It's like pushing 450. I should have just kept buying. But yeah, I mean, I got a lot of exposure through ETFs.
Mhm.
And yeah, honestly, I think they could probably have done more, giving, raising the dividend, putting a little more money in people's pockets. I understand that buybacks are just another way to return cash to shareholders. And it's non-taxable, right? When they buy back shares, hopefully though at a good valuation and not when something's way overvalued. But I don't know. As a person that loves passive income, I think they could have maybe went a little heavier into dividend raises. Maybe not like Nvidia. What did they raise theirs? Like 120% or something?
Yeah, it was quite outrageous. But I mean, it was at a penny a quarter before, so it doesn't it
Right.
doesn't take much to have a massive increase for
Yeah.
them. But yeah, Microsoft definitely could raise it more. And buybacks are good, but you have to sell your shares to take advantage of those buybacks. So that's not our game. We're here for the income and the dividends and things like that. So still very solid. I mean, between the yield and the raise, or over that 10 that you see on the oh god, what's it called? The when you add the dividend yield
The
plus the
shareholder yield.
oh man, I'm going to come back to this. Getting it totally
Yeah.
blank right now. But anyway, so it's still a pretty good package for Microsoft. You could definitely do worse out there.
Oh, you're
And
talking about the Chowder rule?
thank you. I don't know why that just yeah, exactly the shadow rule. So
Yeah.
when you add them up, you're still over 10, the number 10 for the shadow rule. So still a pretty good package there, if you will. I want to get your opinion on Texas Instruments. They just raised their dividend today. It was only 5%. It's a little bit less than half of what their normal raise. Do you have any insights on that one?
I don't, but I pegged them a little while ago. I did a video on potential dividend cuts, and they were one of my long shots that could potentially cut the dividend. It was all because of the payout ratio, the free cash flow payout ratio, as I remember, was creeping up right around 100%. Maybe even it was over 100%. It's been a while, but yeah, I don't know. I looked in the business, and for me, it was um, a little bit difficult to fully understand and comprehend at where they might be going and understanding a moat that they have. So it kind of went in my too hard pile, but I know a lot of dividend investors. Do you invest in them outright?
Yeah, no, I don't. So in that space, I went with Broadcom and Nvidia are my two main ones in that space, if you will. But yeah, so I was looking at it today, and the Texas Instruments payout ratio based on earnings is 90%. So that's quite high. So I know cash flow is a little different, but yeah, I'm not surprised that they only raised it 5% based on that payout ratio. But compared to their historical raises, it was quite the shock. It was only five when they were usually at like 11 a year. So I just find that very interesting. I saw a couple of people on X saying, at least it's something. And so that kind of goes back to your point where they might have not raised it at all if they weren't trying to keep their streak alive. But so we'll see how the next year goes. Hopefully they can lower those payout ratios to make it make sense. So
Yeah,
uh,
and sometimes companies, right, they kind of get stuck like paying the dividend where if people weren't expecting it and it wasn't in the limelight, if they might not have raised it at all or even did a slight reduction to use the money for paying off debt or doing other things, which is kind of like variable dividends. I think some businesses it would do them well to pay a variable dividend, which if you're new and watching, it just means that it's a percentage of one of their numbers of revenue or or earnings per share, whatever it may be. So I think Smith and Wesson, I think, does a variable dividend. There's a few others that do it too.
I know it's very popular in Europe to have that style. So a lot of European companies will do a standard dividend one time during the year, and then they'll do variable at the end of the year based on the returns of the, different metrics, as you said. So yeah, it's not unheard of, but it's just not the American way, if you will, American company way. So we like our consistent dividends here, but it may not be for the best interest of the company to maintain that, especially if the ratios are getting out of line.
Oh man, then you get into goofy things because then they get nervous. They don't want to cut the dividend. They may try and issue shares or use debt to fund the dividend, and you get some of these goofy financial manipulation shenanigans going on. And so for better or worse. But you're right, man. It's over here. We love our dividend raises.
Well, it goes back to your statement earlier, follow your businesses. You have to really know what's going on. If you're going to be an individual and stock investor, you have to know what's going on, and not just the headlines. You really have to dig into it to make sure that the management is making the right decisions and they're not doing all this tricks behind the scenes to make it work. So very good. All right, so let's transition over to our main topic of the day, and that's as a newer investor, if you're just kind of getting started, we talked about quote unquote the younger people getting started and some of the things that they should look to invest in. Last time we talked, but let's talk about someone who might be closer to retirement who's looking to be a dividend investor. So, any kind of advice, recommendations? Obviously, we're neither of us are near retirement, but we've both been in this game long enough. We do our research and we have a good understanding what's going on there. So, what kinds of things would you recommend people look out for or consider if they're starting dividend investing later in life?
Right. So from people in the community that I've talked to that are retired and living off their dividends, one of the big things that they say is just looking for that stable and predictable income. So you're not so much worried about the share price appreciating because you're in capital preservation mode. Like you're trying to preserve your capital instead of accumulate and grow it. So yeah, just companies like a Johnson and Johnson or a Walmart or Altria, if you don't mind the cigarettes, the Sin stock, things like that. Companies that are really big, really mature, don't have a lot of growth going forward or growth vectors, but they're just, as Charlie Munger said, drowning in cash, which is a good problem to have. So they're returning a lot of that cash to shareholders. But yeah, the days of the growth of the business are gone. They're just not there. So I think that's probably the easiest thing. And a lot of people I've talked to, it kind of reminds me of The Wedding Singer with Adam Sandler. Remember at the end, I want to grow old with you. You can do that. Some of these people, they get in when the company's young and growing and paying a really fast growing dividend. The share price is growing. And then you hold it for 20, 30 years. You stick with it. And then by that time, it's like a big mature company. You've grown old with it. And
Yeah,
it's just showering you with cash. So that's probably my number one is focusing on boring Procter and Gamble, big blue chip, don't have a lot of growth, but they're gonna be here for a while. Swimming in cash.
there you go. Yeah, so I think one of the biggest things I would recommend for people is you are looking for the stability, you're looking for the income. You don't have the time to worry about a company raising their dividend. Um, like you see with some of these, like Visa, for instance, it raises theirs 15 to 20% a year. You need the income now. And so you need to look for companies who are paying it on the higher end of the safe range. But as long as you're keeping up with inflation after that, you're probably in a good spot in retirement because you're not looking to your point, grow your income or grow your account balances. You're trying to provide for your lifestyle. At this point, you're using the money to live off of. You don't want any gains. You don't want any ups and downs. You don't want any risk of dividend cuts because that's going to directly affect your income. You don't have 20 years left to make up for it, like you and I do. You might have the risk tolerance, but you don't have the risk capacity for losses. So you got to keep that in mind. Some of the names that came to mind for me, if you want to go individual names, is something maybe like a MetLife or Prudential Financial. Some of the insurance companies, super stable, still growing, but they're going to pay you, between 4 and 5% yield right now, with a little bit of growth to keep up with inflation. Another one was Main, so Main Street Capital. So I think you're involved in that one right now. But
Uh,
that's 8.2% or so yield.
mhm.
So that's pretty good.
They're monthly too.
Monthly paying, which it
Yep.
really helps out if you're living off the dividends in retirement. Another one that I personally like is some of the covered call ETFs that are coming out right now. So your SPYI and your QQQI and your JEPQs, things like that are going to pay you the high income, but you're not going to get any growth. But that's to your point earlier, you don't really need the growth. So what's your opinion on some of those covered call ETFs that are coming out right now? They're very popular, always in the financial news lately.
Well, they don't have a very long track record, that's for sure. I'm struggling to think of any that are maybe older than 2019, 2020. I don't know when JEP-Q came out.
Yeah, JEPQ is
Uh,
pretty new. JEPI has been around a little bit longer, and they also had a mutual fund version of JEPI before. It's called JEPX, JEPIX. So they have a little bit more history, but you're absolutely right. They haven't been around very long.
yeah, so I think with ETFs, where you're buying the underlying, so you have to understand what's under the hood, how they're working, and you're still tying yourself to options, which are derivatives, and they can be a lot more volatile. I know that they try to sell themselves as not being. I think Kevin Simpson, right? You've read his book, Walk Toward Wealth. Walk toward wealth. Yeah, we talked about it. He runs DIVO, which is blue chip. Like, he tries to do it the right way. So you're still owning the underlying, and that goes with any ETF, no matter what it is, and you have to be okay with that. But yeah, I'm kind of got my popcorn ready, waiting to have a really long, just recession, stock market recession, where things correct. Obviously, that sucks if you're, retired and you need to sell shares, but and of course, selfishly, I want to get shares of great companies cheaper, but I also want to see how the covered call ETFs perform when we're in a bear market, and if it's a year long or more. So
Yeah,
they haven't really been battle tested, I don't think. So
definitely. So
yeah, they can be okay, I think.
yeah, covered calls and cashier cure puts have been around forever, but in the
Yep.
ETF wrapper, that's something that's relatively new. So my recommendation is don't put a lot of your money in it. If you are interested in that higher yield, maybe a few percentage points total. Test it out for a little while. Don't rely all your income on them at this point.
Well, they always say, what do you think of the saying, the higher the yield, the higher the risk? Do you think there's truth to that? Do you think people, can make the mistake of trying to chase yield even if they're retired?
Oh, absolutely. If you can get 3% on Johnson and Johnson, but you can get 12% on this fancy ETF, I mean, it's very appealing to give it a try. But you have to truly understand what they're doing, how they make that 12%, and the sustainability of it. Covered calls, yes, you can make 12% a year, but you have to make sure that the ETF, the management company, is doing the right thing, and you understand what they're doing. Other things I would recommend for people near retirement is actually to kind of skip over stocks altogether and maybe look at some bonds. So there's a lot of interesting bond ETFs right now. So AGG is your aggregate bond ETF from iShares. Very broad. I think there's like 5,000 something bonds in there. That's pretty stable. Or Vanguard has one. There's a BND. There's a lot of
Yep.
bond ETFs to kind of insulate yourself from the ups and downs of the stock market with, bonds, and they're paying between 3 and 5% right now as well. You could also go active bond ETFs like BINC from BlackRock. So there's a lot of different ways you can gain income and not be in the stock market. So any bonds that you're interested in or you see out there?
No, the only thing I really did was a treasury fund, SWVXX, when I sold out of Toronto Dominion Bank TD, which I should have held a little longer, but hey, that was personal choice. They're under investigation for anti-money laundering, and I just Charlie Munger, God rest his soul, said how he said this in 2013 at the annual meeting, that financial institutions like the big banks, that there's so many things that they do. There's tons of notes in the financial statements, a bunch of gobbledygook. And he said it's really hard to understand. It's much more difficult to understand how they operate and make money than it was 30 or 40 years ago. And Warren agreed with him. So if Charlie Munger is saying that it's really difficult for him to understand the big financial institutions and banks, it kind of makes me think like,
Yep.
what am I going to understand here? I mean, so
Yeah.
I ended up getting out. After dividends received, I basically broke even. I should have held a little more, but hey, hindsight's always 2020. So we can't get down on ourselves for not knowing the future. Which I don't know, man. That's a investing little thing, is that you have to make the best decision with the information you have right now, and you don't know what's going to happen. So as long as you made the best decision with the information you had, sleep like a baby. I did that with TD, and I mean, you can't look at the final score of the Super Bowl and say, like, damn it, I knew I should have put. No, you don't know what's going to happen.
Absolutely. Yeah, I used to have TD and I had JP Morgan Chase for quite a while, but I got out of banks altogether because, to your point, there's so many risks, there's so many unknowns, there's so many regulatory hurdles that they have to get over. I just don't find it to be appealing anymore.
At least individually, I'll take my exposure through my mutual funds.
Exactly.
That's going to be good enough for me. But I'm trying to stick with businesses that I really do understand going forward. And some of them I do have, though, like Prudential. I've told people I'm going to be buying a car. We're going to be buying a car eventually here when we find the one we want. But I think Prudential is one of mine that's on the chopping block to help finance that. And again, there's some things I don't understand about it, and there's a ratio that they are not doing so well on, that shows the money that they take in versus what they have to pay out, the difference, and it's from what I've seen. Anyway, so that's probably a little too granular, but.
So the company I work for, part of what our business is insurance. So we do car insurance, life insurance, things like that, home insurance. And the last couple of years have been very tough for insurance companies because the prices of repairs, the prices of rebuilding a house or repairing a car has skyrocketed with inflation. But they haven't been able to keep up with the increases in your premiums because you do them a year at a time, things like that. And a lot of the states only allow them to raise it X amount of money per year. So there's a lag there. So to your point, insurance companies have all these expenses coming in, but the income that they are generating from their policies is still lower. And so it's been very rough for insurance companies. So you're right on that.
That's their combined ratio, I think it's called.
Okay.
Yeah.
So just a real world example is it absolutely is happening ever since COVID and inflation, and the cost of goods has gone up, cost of repairs, and also cars and things are getting more technologically advanced now. It used to be metal and a couple gears. Now it's computers run these cars, so all the repairs are much more expensive. So it's a tough business to be in for sure.
Yeah.
All right. So the last thing for people who are in retirement looking for income, the last thing I would recommend is maybe look at some closed-end funds. So those are closed-end ETFs or mutual funds, and so they take investor money, set amount. That's why it's called closed. And once they receive that money, then they go out and buy different investments. So they can buy stocks and bonds and all kinds of different things. They can take loans out on the stocks. They can do all kinds of different things. But closed-end funds, generally speaking, have a higher payout and a higher yield than some of your traditional ETFs and your individual stocks. So I have quite a few closed-end funds myself, but I was curious if you invest in any right now.
I do not, man. That's all your wheelhouse. But I did read The Income Factory by Stephen Bavaria, and I got a little bit of a better feel for it. And it's because of that. That's why I started positions into Main Street Capital and Ares Capital, to business development companies, corporate companies. But yeah, I have not gone the closed-end fund route. But I know that you do, man, and
Yeah,
you know what you're talking about with them.
I appreciate that. Yeah, so ones I really like, especially that are more stable, is one called BDJ. It's the BlackRock Enhanced Equity Dividend Trust. As the name suggests, they invest in dividend stocks, and they also do covered calls on a portion of the holdings to generate a yield. It's paying about 8% right now, so it's not too bad. One thing you do have to look out for closed-end funds are the expense ratios. They can get quite expensive. I'd say the typical one somewhere between 0.60% expense ratio and like 1.1% a year. But you do see some of these closed-end funds that can go up to 2 or 3% a year. So it's definitely
Wow.
something to be aware of. That's money out of your pocket, so you really have to look into them. Some other ones that are out there is let's see, SKT, which is a technology-related one. There's BME, which is medical, like healthcare related. So there's a lot of different closed-end funds that pay really good payouts. So if you need that higher yield because you need to hit a certain income, there's something to look into. But definitely do your research for sure.
Gotta be careful, man. That passive income's a hell of a drug, you know. You dabble with something a little bit stronger and then you're hooked. Yeah.
Exactly, and that's why people love these covered call ETFs that we were mentioning earlier, because that 12% a year yield is very enticing. You get addicted to it really quick.
Yeah, 3% J&J was looking nice until you tried the JEPI at 12%, and then you got a strong hit of that, and it's tough getting off it.
It really is. Another recommendation I
Oh man.
have for people is
Mhm.
put them more fun to invest in individual companies. But with it being your livelihood, the income you're producing, I would definitely consider ETFs. So things as simple as SCHD or VNQ for your REITs, something very broad, something very boring that's going to pay you consistently. You don't have to worry about, to your point, a management company coming in and blowing up a company, management blowing up a company, or the latest headline of a bank money laundering scheme, ruining your income. So by diversifying with an ETF, you're going to smooth out the ride a lot better, especially when you're relying on the money.
Yeah, and with the stock market, man, one thing I've learned is that if something can be sold, it will be sold.
Mm,
And not everything is worthy of buying and investing in, because some things, unfortunately, do look like they're designed to separate you from your money, and they're made to enrich the entities that are running some different funds or investment schemes. So yeah, you just, it, I mean, my God, you have communities now you can plug into and get opinions of people. You can use AI, you can use X, our communities, there's Facebook groups. I mean, there's no excuse to get caught with your pants down before you buy something. I mean, on Reddit, there's retirement, there's specific groups of people that are retired and living off of their passive income that
mm.
you can literally just ask their opinion on something before you go ahead and put money into it.
Yeah, like 10 years ago, 20 years ago, these forums didn't exist. But now, to your point, we have Facebook groups. Any kind of investment related theme you're looking for, you can find a group that talks about it. Whether that's options writing, whether it's dividend stocks, whether it's covered calls, whether it's closed-end funds, like you name it, there's a group out there. And to your point, Reddit, X has a lot of great people, individual investors, as well as professional investors on X that you can go reach out to and get opinions on. And to your point, there's so much information available to us, both in written form and people's opinion, that you really don't have any excuse at this point anymore. So, but if you are looking to live off dividends, take it slow, be consistent, spread, diversify. You don't want too much in any one basket, because if you do get a dividend cut and that's your income and you lose 10% of your income, are you going to be able to pay the bills? So definitely be very diversified and very safe if you're living off your dividends.
Hey, or sometimes you're just gonna have to go ahead and put money in, get skin in the game, and learn that way. Because trying to learn off of watching a model portfolio, it's kind of going to be like trying to learn how to make love from reading a romance novel. It's just not the same thing. So sometimes, the biggest and best lessons that I've learned are when I've actually had money on the line in the game that I've lost and made mistakes with. And hopefully I don't repeat, because the first time it's a mistake, but the second time it's a choice. So just trying to be a little bit better and smarter than you were yesterday. And yeah, I'd love to hear it, man. Someday we'll be there. We'll be retired living off passive income, and we can do this again and give our
Exactly.
thoughts as actual retirees.
Yeah, yes, absolutely. So very, very wise, guidance there.
Ah,
All right. Let's transition a little bit about
yeah.
valuation. So this is a continuation of our discussion the other week on your channel. We didn't really get to talk to it. So you can buy a stock at any point. You can literally pull it up on your phone and buy it, but maybe it's not always the best time to buy a particular stock. So some of the ways you can determine if this is the right price is to run a couple valuation methods. So there's a lot of different ways out there, but can you give your one top two or so that you really look for when it comes to valuation methods?
Yeah, so I'm skeptical on discounted cash flow analysis,
Hmm.
taking projected future cash flows, giving a terminal value, discounting it back to today at the appropriate rate. Just so many subjective things. And I guess I felt a little bit of validation because people will tell me like, no, you have to put a valuation on it. Aswath the motor and is real big on that. Like, you have to value it no matter what. And then a fellow countryman of his, I read a book by Pulak Prasad called Everything I Learned About Investing from Darwin. He literally just said that the same thing that I've been feeling is, if you think a company is going to keep making more money and growing the business and being more profitable years and years and years into the future, the stock price is going to go up. It's going to follow those earnings and profitability. So if you buy right now, it will be more valuable if that keeps happening. And I love it because he said, I don't even bother with the any kind of discounted cash flow analysis because it's so subjective.
Hmm.
And there's a saying that says, with discounted cash flow analysis, one of the problems is it's like looking in outer space through the Hubble telescope. If you turn it 1 inch to the right or left, you're looking at a different galaxy. And it's just a simple fact too. And I won't go on forever about it, but when you look at like price to earnings ratio or dividend yield theory, which means you're looking at say the 5-year average of the dividend, and if the current price is higher than that, then it's might be a good spot to buy. And if it's below that, you probably want to wait. But again, those are all backward looking. They don't tell us anything about the future. The problem with doing that for PE is that the E, we don't know what the E is going to be in the future. So look at the past all you want, which can give clues. But again, we just, nobody knows the future, which makes it so interesting because nobody's ever seen the way that this movie ends.
Yeah, for sure. You can do your best guesses. You can look at analysts, determine what they think it is. But to your point, it's just a guess. If they say it's going to go up 10% a year for the next 5 years and it goes up 9%, how does that affect your valuation? It changes it a lot, to your point. So, if you are going to try and value a company, use a lot of different methodologies, get a consensus, and then also use your own judgment. Do you think that what they did in the past is going to continue in the future? Every company has different cycles. It has different maturity, if you will. So just because an Apple went up 15% a year for the last 20 years, the next 15 may not be 20% a year. So you really have to think about it, what the future is going to look like, the best of your ability. So I am more of the type that prefers just a dollar cost average over time to buy when I have the money and don't really worry about valuation. I used to be a value investor, quote unquote, and I used to run all the discounted cash flows and the PE ratio, mean reversion, and all those things. But to your point, a lot of it's just guesses. And so if you're going to buy quality businesses and you plan on holding them for very long times, like we do as dividend investors, if you overpay by a dollar or two today, is it really going to matter 20 years from now? Probably not. And so take valuation with a grain of salt. It's great to get an idea. You don't want to be vastly overpaying, but you don't need to calculate it down to the penny of what the company is worth, because to your point, there's so many unknowns and so many things happen. people that were valuating things in 2019 thinking, the economy is only going to go up, look what happened over the next 3 years. Like COVID happened. There's no way for you to know that's coming. Or, war comes around, or, a major downturn in the economy just completely ruins all your models. So it's really hard. But if you're a dividend investor and you're looking at 20, 30, 40 years, or never using the principal and living off income, this valuation really shouldn't play that big of a role, if you will.
And that's the beautiful thing, is that anybody can beat the pros. Fun story. I actually just talked today about this with my wife, is that less than 2 years ago, and I even tweeted it out, Carvana, which doesn't pay a dividend, but I talk with my wife, and when I drive home around here in the Chicago suburbs on I-88 by Oak Brook, there's a Carvana tower, and it was, it was December of 2022, and I remember telling her, like, wow, it looks like Carvana's going bankrupt. I wonder what they're going to turn that thing into. Are they going to destroy it? It's an odd structure. And how much is it? And I said, it's like $5 a share. She's like, you should buy some shares and just hold them. I was like, no, it's going bankrupt. Like, look at this is terrible. Today, it's $170 a share. And she's like, I told you, you should buy some. I was like, but they look like they were going bankrupt. So
the day, it feels like a gamble at that point.
Yeah. And I told him, like, you know what? But I know if I did, I would have freaking sold it once it hit $10. I'd be like, I've doubled my money. Like, I'm out. But now it's up 4,000%.
Yeah.
But I will share a story that because I wrote about it, was with Visa. Play these little games. It was at $258.50 a share not too long ago, because I want to get something at a better deal. I put in $258.25. So 25-cent difference. I put in a buy order for 2 shares. For whatever reason, it didn't hit. It just did not go down the extra 25 cents. And it just kept going up and up. And now it was just recently like 291, 292. So I forced myself. I said, you know what? This is a business I like. This is a business I think that's going to keep growing. So I bought my 2 shares. I bought one of them at like 290 or no 289, and then the other one today at a 285 and change. So I said, you know what, I'm just going to do it. I'm going to hold it. I'm pretty sure, because Visa's buying back shares, the business is still growing, that it's going to be well over $300 someday. I don't know when that day will be. So enough with the analysis, DCF analysis and all that. I just bought. It may dip. I'll buy more, but
yeah, I'm also buying Visa.
Got myself on the back, even though I could have got those 2 shares a whole hell of a lot cheaper. But
yeah. I never use limit orders for that exact reason, because if you're looking to hold it for any length of time, 25 cents won't make a difference.
Stupid.
Just buy it and enjoy the returns that the business can provide you. Visa is a good one. That's super stable, super strong company. That's not one you want to fool around with and try and get a penny cheaper or whatever.
And the beautiful thing you reminded me of dollar cost averaging is it's I don't know the word, self limiting, meaning that when prices are high, you'll buy less of the thing, and then when prices are low, you'll buy more of it. Yep. It's a very simple, easy way for most people that don't outsmart themselves out of hundreds of dollars because they wanted to get something for 25 cents cheaper.
Yeah, for sure. And that's how we all operate with our retirement accounts, our 401ks, our 403bs, things like that. Is we dollar cost average. We get a certain amount from our paycheck, put in every 2 weeks, and over time, look how many millionaires have come out of retirement accounts. So we're not thinking, oh my goodness, the stock market's too high today, I'm not going to put my 401k contribution in. That's not how we do it. You just put the money in, let it grow over time, let businesses do what they do, let the economy grow the way it grows, and you'll benefit from it. So, all right. Last up, I want to just kind of talk, see what you're looking at lately, what you're buying, maybe what's on your watch list, if you will. I have a couple of things that I'm focused on, but I want to kind of get a sense on what you do. Share with the community, maybe get some ideas going out there. So what's been on your watch list lately?
Sure. So we talked about Visa. I'm also buying Agree Realty. It's finally started coming down. The thing has just been on fire, as most of the REITs have. Ticker ADC.
Hmm.
They're kind of like, I look at them as like the baby brother, like the younger, sexier, more handsome baby brother to Realty Income. Uh, Maybe a lot younger. Like Realty Income's like the big older brother, but I guess Agree Realty is like the oops baby who's 20 years younger or something. But yeah, I think they have a lot more growth trajectory than Realty Income does. Also, Vici Properties. I bought more of them today, ticker VICI. They're kind of like the Las Vegas landlord, but they're also trying to expand into experiential vector of growth, family entertainment centers, water parks, wellness resorts, things like that. So yeah, maybe they're getting out of their gambling. They were actually born out of the Caesars bankruptcy. It's so they were like the landlord part, the property of that whole bankruptcy thing, and then ticker CZR is the operator, I guess, the casino, if you will. I also bought MLPX, more of that, ticker MLPX. That's the MLP ETF and energy infrastructure. Basically, all of the limited partnerships that you would get a K1, almost all of them are in there, but the way that they handle it is when you don't get a K1, so your distributions, or I guess it's a dividend at that point. So it kind of goes through the filter of the company running Global X. But yeah, so been buying more of that to get that midstream exposure in my retirement account, because I made the big mistake of holding those EPD in my retirement accounts. And then one that I'm looking at is Clear Secure, ticker YOU.
Hmm.
And they newer company, 2014. They just started paying a dividend not too long ago. They're growing at low payout ratio. But what they do is if you've been in the airport, they do the biometric scanning for the eyes or the fingerprint, kind of to help you skip the line for identity verification. And from what I've been reading, don't own them yet, but they want to expand into sports
Hmm.
venues, like doctor offices, kind of getting rid of the clipboard, um, partnering with Home Depot during their tool rental stores to try and mitigate fraud. So they want to grow. They're founder led companies still. Um, and then my last one I bought was Nexstar. One more share of Nexstar Media Group. I may need help on that one, because every time it dips below 160, I buy another couple shares. So yeah, I think that one's misunderstood. Ticker NXST, and I could probably go on for an hour about it. But yeah, I'm either going to be really wrong, or it's going to look nice in a couple years.
I know that you've had quite a few videos where you talk about Nexstar Media, so if anyone wants to take a look, they can. Going
I
back
may
to,
have joined a cult, Jeremy. I'm not sure yet, but we'll guess
I'm,
we'll
I'm
find out.
in the Brookfield cult, so we all have our things. Brookfield is BN and BAM and BIP and BEP. There's a whole family of them, but that's my addiction is Brookfield companies. Going back to Clear, I actually did a video on Clear a few months back when they first initiated the dividend.
Really?
I did a whole analysis of the company and talked about what they do and stuff. I'll link it in this video just for
I'm
everyone.
gonna watch it tomorrow, dude. I'm apologies. I didn't even know you did one on them.
So yeah, it's definitely a very interesting company. I had done the analysis right when they first said that they were going to start a dividend, so they didn't really have a lot of history. But it's been a few months now, so it's definitely something to take a look at. I love the fact they're going into sports stadiums and different things to get outside of just the airport. I think that's going to be huge, especially with all the security concerns. They're going to do concerts. They're going to do sporting events. They're going to do schools. Like it's unlimited, and I love the medical part of it, where your biometrics is what stores all of your medical records. So you go from one specialist to the other specialist to the other specialist. It goes with you, and so you don't have to fill out the paperwork every single time. And all the doctors know all your background, so they can serve you better. So no, it's definitely an interesting company. Thanks for bringing that one up. I haven't looked at it in a while, but it's definitely something to look into for sure.
Yeah, they're still looking good, man. Still looking good. And again, I think also I just heard a story about the Seattle airport. I think in Seattle there's some kind of thing going on with cryptocurrency ransom. They want there's I don't even know what it is. There's some information. I heard the blurb. They want $6 million in Bitcoin or something, and it just made me think that all of our data is out there. So this could be a huge thing that for verification of identity, again, just your biometrics, you always got your eyeballs and your fingerprints on you. And it could help potentially avoid, mitigate a lot of fraud and blackmail and things like that.
Absolutely. Unless some people can figure out how to replicate your eyes or do fingerprints, whatever. But yeah, no, it's definitely more secure than just putting it out on the cloud or in some doctor's office computer and then not know who has access to it. So those are really some good options. The ones I've been buying lately is again Brookfield, so ticker BAM, Brookfield Asset Manager. Been buying a lot of Visa lately. What you said earlier. I went ahead and bit the bullet and been buying some Costco lately. I know
Oh, you did it.
the price has been going up a lot, but it is such a strong company, and I plan on holding it for a long time. So going back to our valuation thing, it might be overpriced, but you can't beat the quality of that business.
That's my one. I'm praying. I say my prayers every night. Oh, please, baby Jesus, let there be a stock market crash. I can buy Costco on the cheap.
Right. I don't think it's ever cheap, to be honest, but it's one of those things where they're dominant in their market. They have a great business. They're continuing to expand. Like you can't go wrong. And to your point, they'll grow into any kind of valuation that issues that they have. The
Do you
last one,
shop at Costco? Sorry, do you shop at Costco?
I have a Costco membership and I also have a Sam's membership. So I have a family of 6. I have 4 boys, so our grocery bills are ridiculous. So we go there to get the bulk items. So yeah, we're there all the time. When
Yeah.
our kids were little, we did our diapers and stuff there, and now surprisingly, their fruit is relatively inexpensive if you need it in big sizes. So we go get blueberries and bananas and all kinds
Yeah.
of because our kids will devour them. So yeah, definitely.
We call Costco the $100 store because we can't seem to spend less than $100 every time we set foot in there. It's almost like a physical impossibility.
Exactly. And I forget who it was. I think it might have been Motley Fool or one of the other podcasts recently had a session, a special on Costco. And they said that the appeal of Costco is they're not trying to make money off of selling you their product.
Yeah.
They are working for you to get lower prices. And the way they make their money is on the memberships. So it's a much better business model than your Targets and your Walmarts and things like that, where they're just resellers.
Fantastic business model. Okay, sorry. We could probably talk Costco for another hour or two. So
And the last one I've been really interested in buying a lot of right now is Google. The parent company is Alphabet, is Googl. Obviously, everyone knows Google Search. They have cloud, they have all kinds of different things. They have the Waymo, self-driving, all that stuff. But the reason why they're a good value today is because of all the regulations that they're going under. There's a lot of people talking about breaking them up and regulating, saying that they have a monopoly in search and things like that. And that might be true, but it's still a very strong business. They have tons of cash flow. Even if they get broken up, a lot of times the businesses are stronger independently than they are together. So I've been buying Google, and they just started paying a dividend. So now it's officially something I can buy. So they just paid out their first dividend the other day. They haven't had any raises yet, but I'm expecting it to probably be in the 10 to 20% a year because their payout ratio is like 2.5% or something. It's something so low that's almost laughable. So they have a lot of runway to increase their dividend over time.
yeah, they could be the Standard Oil of the 21st century. I read that story about when Standard Oil was being broken up. Uh, Rockefeller said this is one of the greatest days ever. Like, this is awesome. He wasn't even worried because he knew he was still going to own shares of all the little baby companies that came out of it. And yeah, so I don't think there's too much to worry about. Although I know other people are.
Yeah. Anytime there's uncertainty in the market on a specific name, the price gets pushed down. And as long as you believe in the company long term, I mean, what you have, Google Search, you have YouTube. I mean, there's a lot of businesses that Google runs that are, amazing businesses. So I'm going to stick with them. So awesome. All right. Well, I think we're almost at the end of our session. Just wanted to kind of put it out there. everyone go check out Russ's things. Russ, if you want to give a plug to yourself, some of the things you have going on, where people can find you.
Ah, man, you can just go to dapperdividends.com. I got all my stuff there, all my links, whatever. Just there. We'll see you there.
Awesome. Yeah, and sign up for your newsletter. You always have really good insights out there. I love getting your newsletters every week. Check out your YouTube, all that stuff. So, Russ, really appreciate you joining. I love our conversations. Hopefully, we can do it again sometime soon. And we'll see you
Absolutely.
around all the different socials.
Beautiful, man. Thank you for having me over. I love it.
Thank you so much.